Welcome to Jank and Scott on Risk, the YouTube channel dedicated to the theory and practice of risk management. In this video, we're going to discuss how to model translation exposures and get sort of knowledge about translation exposures into a risk modeling framework. The reason why so many firms keep being surprised by these translation effects is that the complexity of the whole thing overwhelms any given individual, whereas a model can be designed to handle that very well and keep track of all the complexity for you. So that is the topic of this conversation. So please find more information about market risk exposures and translation exposure in particular in my book, Corporate Foreign Exchange Risk Management, co-authored with Alfa Wienesen and Lars Uxelheim. There's also more information on my webpage, riskbudgeting.se. And as they say here on YouTube, please like and subscribe. So we want to incorporate knowledge about translation exposures into a framework for risk modeling. The setting we have in mind for this risk modeling is risk budgeting, which is risk viewed through the lens of the firm's financial performance. So we use cash flow, net income, balance sheet, financial ratios, all these financial numbers to express risk. So we add a layer of risk analysis to these financial forecasts. And this allows us to move beyond the limitations of the risk register, which is not really designed to aggregate risk. So we're looking for something that helps us visualize and describe the risk of the firm as a whole and how performance is at risk. So, and we also are interested in finding ways to investigate how risk will change as a result of different scenarios when the world develops different from expectations, and corporate policies, which is when management implements policies that are potentially very risky and will change the risk return profile of the company. We would like some way to investigate that proactively using a model framework. So that is the setting in which translation exposures are going to be relevant. So indeed, risk budgeting needs to be supported by a quantitative risk model. There's no way around that. And we have a wish list here of desirable characteristics for such a model, two which are having a complete set of financial statement forecasts so that we can derive our risk analysis from that later. And these forecasts of financial need to have sufficient accounting integrity. The internal consistency of these forecasts have to be such that we can consider it a reliable companion for decision support, right? So that's what accounting integrity is, right? We want the whole thing to reflect actual accounting principles to the extent possible. For this purpose, it's helpful to think in terms of a chart of accounts. Actually, yes, we want the model to have a clear, well thought out set of lines included in the financial forecasts. And here's just a simple example. You have some revenue, expenses, assets, liabilities, equity, and cash flow statements. And these are lines we think we're going to need in the model to generate the kind of insights that we find desirable. But, and it's all very simple here, but there's nothing, it's a pretty good idea to use the kind of chart of accounts that you have in the firm's actual financial reports. There's no reason to not use what your firm is actually using in the financial reports. That's a great source of information for a useful chart of accounts, and that way people will relate to your model, and you will catch people's interest in a different way. So that's one tip for your choice of chart of accounts. Then we implement this in a spreadsheet model, right? So we set it up so that the net income statement, cash flow statement, and balance sheet are all there. And the goal here is to fill this up with content formulas in such a way that the model always self-balances, reflecting actual accounting relationships, right? So we get the kind of integrity that is desirable. So, well, the translation exposures, we've covered that in earlier videos, right? We have something called the net asset liability position, which informs us about the sensitivity of consolidated equity to changes in exchange rates from translation of foreign denominated assets and liabilities. And the net asset liability is essentially assets less liabilities when you do that on a per currency basis. So we have to identify all various assets and liabilities in a particular currency, net the assets and liabilities, and consider that, you know, an indication of the sensitivity of our equity to changes in that exchange rate. So we do that for all the exchange rate that we have an exposure to. The net monetary position, on the other hand, is when we subtract monetary liabilities from monetary assets. And we're particularly interested in this because, according to the basic rule, translation effects from these kinds of assets and liabilities are supposed to be shown in net income, which is the bottom line of main concern to many managers, right? So that tends to be of some relevance. And monetary assets and liabilities are those that are like money or a contractual equivalent. So some kind of payable or receivable with a fixed value in units of currency to due on a particular date, right? Debt, payables, receivables, all that stuff. All right, so we want to incorporate elements into the model that allow us to keep track of these things, the net asset liability position and the net monetary position and various translation effects appearing in these financial forecasts. So for that purpose, we're going to add translation gain and loss to comprehensive income, which is we now add this statement to the model. It's a income statement that sits just below the net income statement, and it captures a lot of these strange revaluation effects that take place in as you consolidate the accounts of a company, right? So, and one of those being the translation gain and loss on non-monetary assets and liabilities. So we need this line in the model. We're also going to have a line in expenses we're not talking regular net income, right? So we call that foreign exchange gain and loss, just to differentiate. So this relates to translation effects on monetary assets and liabilities then. So they qualify for inclusion in net income, basically, if they are monetary, right? For this to balance, we also need another equity account called translation reserve. So we add that to our chart of accounts here. So now we have the right sort of setup to make the model self-balanced, even when we change assumptions about exchange rates going forward, right? So we need to have the mechanisms in place for dealing with that. And here's where they appear in the forecasted financials as we set it up in the spreadsheet. We have one line here for an exchange gain and loss in the net income statement. We need to remember to reverse that in the cash flow statement because it's non-cash effective. So that way we keep it from having some kind of unintended effect on cash, right? So we introduce this other comprehensive income statement here, where there's only one single line at this point, which is the translation gain loss on non-monetary assets and liabilities. In equity, we have a fourth line added here, translation reserve, so that forms part of shareholders' equity. So we've just expanded the chart of accounts here. And the trick is to do so and keep the model balancing, because once it stops balancing, we can be fairly sure that we have not set the model up properly, and we need to go back and investigate what we've done wrong. Keep doing that until the model balances. So this is one of those examples where we're slightly more ambitious now. We want to cover translation exposures in our model, so we need to expand the model. And that's a challenge for us as a modeler because we're going to have to be correct about things. And it's very easily the model is not correct, even though you think so. But this kind of balancing feature kind of forces you to be right, and you don't stop modeling until it does balance, right? All right, so for this to get started, we need some ingoing values for the balance sheet. So we're just going to assume some numbers here for plant, property, and equipment, and that's financed with some long-term debts and some equity here. And we're going to assume now that some of this debt And some of this PP&E are actually in foreign currency, in US dollar to be specific. So part of that is actually in dollars, so that when we translate this number using the exchange rate, that gets added to this number. But it's not necessarily only that. It could be, they have assets in other currency regimes as well, notably their own home currency, so which is Norwegian krona in this example. Also, the long-term debt is going to be in US dollars. So the number that we see here is actually consists of one part being a dollar debt and one part being a Norwegian krona debt, which is not exposed, so we don't need to show it here. So we do this on a per currency basis. So if there had been some euro liabilities or assets in this corporate group, we would have shown that here, but there's nothing in this simple example. So this is the relevant data here for us now. So we're going to be taking interest in exchange rates as a result of having assets and liabilities in foreign currency, right? So this currency rate, we have to come up with a base forecast, which is 8 in this case. So in all quarters going forward, we believe 8 is a reasonable prediction. Then what happens is that we're going to investigate a scenario. In this case, the scenario is an exchange rate change of 10%. So the dollar appreciates and it's stronger at this point. So what does that mean for our financials then is the question. Well, we have to first realize that these translation exposures are forecasts. We just saw the initial numbers on the previous page, but unless any other event takes place in the model, that's also going to be the forecast going forward. Slightly unrealistic for sure, but never mind the details there. So meaning that we're going to keep an asset of 50 here in the books and a debt. So there's no repayment or additional borrowings in this currency, right? In dollars. So when we translate that to Norwegian krona, we get these values, right? And because we're assuming now a stronger dollar, we're going to find that, well, the Norwegian krona value of US dollar assets is going to go up, creating a gain. That's beneficial to us in the accounting world, at least, and but also in the real world in many cases. The long-term debt is similarly translated at a higher exchange rate, so that is going to be a loss because we now have to service a debt in a currency that is stronger. So that counts as a loss, right? So we have to keep track of, or ask the model to keep track of these things. So for the asset, the appreciation means a translation gain, right? It's a non-monetary asset, so we're going to differentiate from the foreign exchange gain and loss here, which refers to the monetary asset, the debt. So the difference between 264 and 240 is 24. So that appears here as a loss in that quota, right? So where do these go then? Well, we're going to send the foreign exchange gain and loss into the net income statement because it's a monetary liability. We're talking about the debt here. So it qualifies for inclusion in the net income statement. So we show it here as a loss. And that sort of becomes the entire loss in that quarter because we're ignoring everything else. But we also need the other comprehensive income statement, which we have introduced into the model. So we register the 40 gain there. How can we make these things balanced then? Well, first of all, again, it's a non-cash effective translation loss here, right? So we have to reverse that in the cash flow statement. We always do that. Whenever we find something that is not 100% cash effective, we have to first reverse it and then add whatever portion is cash effective. But in this case, there is no cash effective portion, so it's only about the reversal, right? So we stop it from having a cash impact on cash here. So that's one thing. And then we need to use these balancing lines that we discussed in a previous video, right? So that we have an ingoing value of PP&E, but then there's a translation gain here in this quarter, so that the outgoing value in Norwegian krona terms will be higher. And that, absent any further events, that will also be the ingoing value in the next quarter, and this process repeats itself. So we use these balancing lines exactly for this purpose, right? To just absorb and incorporate these events. Whereas on the liability side, we have long-term debt being also revalued or retranslated in this quarter. It's 24 higher, so it's a higher value outgoing for this liability. Then there are no further events, so it stays at that level. Retained earnings will show a decrease. The ingoing value is 200, so we're at that level until the event happens, and boom, it goes down because the translational loss from the debt is the only thing that happens in this quarter as far as net income is concerned. So that's the loss, bringing retained earnings down by 24. So these two balance now. I mean, we have one thing on the liability side and one thing on the equity side, so they cancel out. But there's nothing canceling this one out here. The assets are going up, so there has to be some kind of benefit on the equity side here. And indeed, you're seeing a boost here in the comprehensive income in that quarter, right? So, and we're using the translation reserve for accumulating whatever goes on in the other comprehensive income. So that becomes part of this equity reserve now. So after the event, it's parked at 40. With that, the whole thing will balance. Look here first that we're starting out by writing up the value of PP&E and the value of debt is also higher because of the higher exchange rate. So the Norwegian krona balance sheet will show higher values. And that we account for as a loss in the net income statement and as a gain here in the other comprehensive income statement. Together, that generates effect in equity that is exactly what we need for this to balance. So we're seeing the decrease in retained earnings, but there's a simultaneous increase in the translation reserve. So there's a sort of permanently higher level here for inequity. So this is a good thing. We're able to make things balance here. So there's, we're going to be happy about that. One final thing though, before we conclude, did the net asset liability position predict a change in shareholders' equity? I mean, one of the points by having a net asset liability calculation is that you're able to predict what's going to happen, and you can use that to manage your exposures, right? So we would like to see that to be the case. And the net asset liability is 20 in this model because we're going to subtract the US dollar debt from the US dollar PP&E, the asset. The net of those is 20. And if you multiply that by the exchange rate change, 0.8 here, you get 16. Which is exactly the change in equity from this exchange rate scenario. So again, it worked. Some conclusions here then. Translation effects on assets and liabilities can have major impacts on financials. I mean, these were very simplified numbers, but in actuality, the numbers can be significant, how the financials are moving around quite a bit. And if we can predict that accurately and incorporate that in our decision support tools, we're going to be better off. We're going to have more success at understanding our financials. We can and should capture these in a risk model so that it becomes more accurate and takes due account of these revaluation effects in different scenarios. So we can have a more realistic and accurate depiction of our company in different scenarios. And by insisting that the model self-balances, we can add this model quite safely. I mean, it's somewhat complicated. I mean, it's not trivial to implement this in a model, but as long as you know that in the end it has to balance, you can just keep going at it until you see that it balances. Then you know the whole thing works and you're correct and you can start trusting in the model. So that's a good thing. And yeah, thank you for listening. Please read more in my books, Corporate Foreign Exchange Risk Management or Empowered Enterprise Risk Management. There's more information on my webpage, riskbudgeting.se. Please like and subscribe and have a good day.